Hey everyone, Eric Dutram here for Zax.com. We got a special feature for you guys today. We're talking with two of the top people at OShares Investments. We've got Connor O'Brien, the CEO and president of OShares, and then we also have Kevin OLeary, the chairman of OShares, probably best known for his work as Mr. Wonderful on everyone's favorite TV show Shark Tank on ABC. We really have a wide-ranging interview with both these guys. Talk about their OShares ETF lineup, which celebrated its one-year anniversary just recently. Then we also discuss what's going on in foreign markets, and also at the end we got some tips for some first-time sharks out there as well. So it's a pretty good piece, and we're just going to get right into it after this. So first question, why did you guys get into the ETF business? And for Kevin in particular, was this on an episode of Shark Tank that I missed? I don't remember an ETF company being pitched on any episode that I saw.
Great question. But the truth about this is, way back in 1997, I had a large liquidity event. As many other founders of a learning company, we sold the company for $4.2 billion to Mattel. And many of us at that point decided to set up family generational skipping trust. And back in those days in Boston, a typical trust would look like this: 50% equity, 50% fixed income, rebalanced every January 31st, with some basic covenants about distribution and concentration. So no more than 5% in any one name, and that would be a test against equity and debt. So if you own GE stock and you own GE bonds, the trust couldn't have more than 5%. In addition, we wanted this to last forever, so we wanted to be represented in every sector, but no sector more than 20%. And of course, back then, most of these trusts, and you find hundreds, if not thousands of them out in the market today, in family and institutional mandates, we paid out 5%. That was our bogey. Every year we paid out 5%, and that supported the charities and the family members that were actually supported by the trust. And so that was a very simple thing to do back in 97, was to simply, buy a ladder of government bonds yielding way over 5% and pay it out. Over the decades, that's become harder and harder as interest rates have gone down. And so the genesis of OShares came from a long time ago, almost 10 years ago, when after trying every single strategy and asset class for decades, I started to notice that every 5, 7, 8 years, no matter which manager you use, they went flat or they blow up. And I've used pretty well every asset class you've ever heard of. From hedge funds, I've owned forests, I've had all kinds of alternative assets and all the traditional bond and equity managers. And that's about the time Connor and I got together. I approached Connor and he approached me and said, why don't we form a mutual fund company and you can seed all of the mandates with your trust, and we'll make sure that it's toward the mandates you need, conservative in nature, but we know you have to pay out 5%, so let's look at dividends, etc. And over the years, we started to see the advantages of ETFs. And so about 3 years ago, I asked Connor, listen, can you go research all of the ETFs that pay dividends? The equity side of my trust has to pay out as well, so let's go look at the 49. And there were 49 at that time that paid out dividends. And here's where it gets interesting. Remember when I started answering this question, I said that I can't own more than 5% in any name. Lo and behold, all of those, the majority of them, of those ETFs were created to support mandates like mine, conservative with some form of payout, were market cap weighted. There's very good ETFs out there that are market cap weighted indexes, which means that 1 or 2 or 3 of the names are way over 5%. In fact, maybe 10 names represent 30% of the entire index, and I couldn't own any of them. And that's when the two of us approached FTSE Russell and said, gentlemen, there must be thousands of people like me that have this problem. Why don't we work together to solve it? And that was the birth of OShares. And Connor designed them with the guys at FTSE Russell, this amazing team of researchers and analysts, to really try and fit my trust mandate. And we've created ETFs that are designed for really long-term investors that have the same challenges I have. And because they're so well-designed, these are multi-factor. This is the new generation of ETF. This is the way things are going to go forward, because I'm never going to own a market cap-weighted index. I don't want to own an index when a name like Apple blows up and it's heavily weighted because it's so large in market cap size. I want to de-risk my portfolio that way.
Yeah.
And lo and behold, after our first-year anniversary, the design that Connor and the guys at FTSE Russell came up with, it's outperformed the S&P by over 10%.
Yeah.
And it's paid out 40% more yield on the S&P right now is under 2%, and here we are close to 2.6. I'm ecstatic. This is, for me, the way we're going to use, and we've not just done USA, we've done Europe, we've done Asia. This is perfect for my trust. And many other investors may find these tools work for them too.
Right, and that's a really good point. We've seen a lot of companies out there moving towards this smart beta theme, trying to go beyond market cap weight into some of these other fundamental factors. Maybe you guys could discuss some of the factors you guys look at when you're creating your O-Shares funds. Connor, maybe you could take this one for us.
Yeah, sure. So first is what Kevin actually asked us to try to achieve with the index strategies in these ETFs. Kevin's a very conservative investor. We've been business partners for about 10 plus years. He's a great partner. And here's what he asked for. So let's see if we can get 20% less risk, meaning less volatility and less downside when the market's down. Let's get 50% more yield. So if the S&P is yielding 2 and a bit, I'd like to see 3 and a bit. And I want full sector diversification. I don't want to be invested in just 2 or 3 sectors. I want really every single sector represented and nothing more than 5%. And underlying all of it, build on the foundation of quality. So that essentially all of the stocks, all the components of the portfolio meet some quality metrics.
Yeah, maybe you can talk a little bit more about the quality aspect. After all, quality can mean a lot of things to different people.
That's right, and some people think it's actually a personal judgment. It's actually very financial metric driven, and it's a very distinguishing characteristic that makes our ETFs different, and I believe has contributed to a lot of that 10% outperformance Kevin mentioned. That outperformance applies not just to OUSA. We've had very strong performance in our Europe and our Asia portfolios as well, driven a lot by the quality metrics. So you mentioned a minute ago that there are a lot of funds coming out or have come out with specific factors or smart beta. Most of them are what we call first generation. They're driven by one specific criteria. The stock has to pay a dividend, or it has to be low volatility, or it has to be something. What we did with FTSE Russell is create a set of criteria, and the stocks have to score well on every single one of these criteria, not just one of them, all of them. So the quality metric is really a set of measures of leverage, earnings quality, so avoid accrued earnings, meaning non-cash earnings. Remember Enron and WorldCom? They didn't get the cash, they didn't get the earnings, and didn't end well. So you want to avoid stocks like that. You want to avoid stocks where the asset turnover is slowing down. Imagine a grocery store that has inventory, and all of a sudden the turnover slows down. Instead of turning over every 2 days, it's 3 days, 4 days, 5 days. Well, it's a bad sign for the business. That's a great financial metric. And so FTSE Russell has done decades of research, has all the data, and drives the portfolio process through the index that they've created that's driven by the quality metrics, the volatility metrics, and the yield metrics. You combine it all, you basically end up owning about 1/3 of the S&P 500 stocks. 2/3 are excluded because they are not strong enough on one or more of those metrics.
Okay, Connor. Well, how do you weight the metrics? Are they all equally weighted, or are there some you focus in on more than others?
Great question. Yes, they are equally weighted in the following way. Every stock gets scored between 0 and 1 on basically a bell curve. Everyone remembers their high school statistics probably. So the stock that scores exactly in the middle of the quality range gets a 0.5. The ones that's the best gets a 1. Same scoring of 0 to 1 on volatility and on yield. And then the 3 scores are combined by multiplying them. And then that gives you an aggregate score. So a score close to 1 is very good. A score below 0.5, probably out of the portfolio. And then the weighting is that score is multiplied by the market cap to drive the ultimate weighting of each stock that's in the portfolio. We have 140 stocks in the portfolio, every sector, nothing over 5%.
Okay, maybe you could talk a bit more about the focus on dividends. Some people these days argue that dividends aren't as important as they used to be, thanks to the rise of tech companies that don't pay any yields. So why do you guys think dividends are still important?
Tech companies that succeeds and doesn't pay yield, there are a larger number that fail. But Kevin's got a long-term answer on dividends. I'll let him answer that one.
Yeah, when we were looking way back and setting up the trust, and we went back 40 years and looked at where the returns came from the market. When you think about creating a long-term strategy is a huge mistake in my view. And I'm not saying you shouldn't own stocks that don't pay dividends. It's just that when you think about the core of an investment strategy that's got to be long-term and it has to be conservative and has to support people and charities for forever, in perpetuity, you can't ignore that fact. And, we don't just mine for dividends. We don't buy stocks just because they pay a dividend. I don't want to own an overweighting utilities when rates are going up. We're very calculated in focusing on the quality of the balance sheet with these strategies. We care about companies that are able to take their business model and make sure that they're able to maintain it, and if not just maintain cash flows, but we like the ones that are growing them. And so their balance sheets continually get better in quality, and that keeps up our scoring system, bringing them up in terms of where they deserve to be in our industry. This is about mining for the very best performing companies in every sector. For example, when energy was falling out of favor, we didn't just exit the whole sector. We bought the best balance sheets in energy, and of course they performed very well on the recovery of oil. But not just domestically, we're doing this globally. So we're doing it in Europe, we're doing it in Asia, we do it in Australia, we do it in Japan. And for an investor like me who invests globally in this trust mandate, these are the tools I'm using for the equity side of my portfolio. I think after trying for a decade to find a better solution, this is the best I could find.
Okay.
Eric, there's an interesting point that follows Kevin's comment on energy, and frankly, it applies to all sectors. The decision to include any stock is driven by the rules, and as energy stocks prices declined, their yields went up.
Sure.
So a lot of the large cap, stable, dividend-paying energy stocks ended up with yields that helped them score well enough in the scoring methodology to overcome what is slightly higher volatility. So those that had good yield that improved, balance sheets were very strong, ended up in the portfolio. So you end up with Exxon, Chevron, Schlumberger, those type of mega stable global companies. And it's been actually a good thing for the portfolio. And the same applies across various sectors. The other thing that I guess Kevin was talking reminded me to mention, in terms of keeping risk down, which is an important objective of many investors, and of course it's one thing that we wanted to see in OUSA, the stats now show since inception, our upside capture and our downside capture ratio is very, very interesting. We get more than 90% of the upside blended across all the upside periods, and less than 50% of the downside. So the quality stocks help you win by losing less. And that goes right back to that set of rules on the three factors developed under our, it's called wish list, but by FTSE Russell and their huge team and huge resources. So that upside downside capture, a lot of advisors finding it to be very, very attractive. Over 90% of the upside, less than half the downside.
Yeah, Connor, and we've really seen that this year with how the market has been behaving. When we look at OUSA against the market over the past year, it really earned its keep in that brutal January-February period, arguably thanks to that low volatility and the positioning in some of the better oil companies out there. Now, this didn't just help your product, but it helped a lot of other funds out in the low volatility world too. So this is definitely a viable strategy for investors out there. But I did want to switch gears real quick and talk about international markets. You have a couple products in these areas, OEUR for the European market and OASI for the Asian market. Are you looking at both these equally, or is there a market you're more focused in on right now?
Let me start, Connor, by just saying as an investor, if you go back when we were doing the work on determining where the returns came to the market over 40 years, we also did what I call a heat map of which indices actually outperformed each other during longer periods of time. So if you go back, all of us sitting here stateside like to think that our industry outperforms every other one every year. It's simply not true. 50% of the time, either the Asian or European indices beat us. And you don't know why or when, but for investors to ignore that is a huge mistake. So when we were designing the whole mandate and the OShares platform, I asked Connor, looking at that data, saying, how do I know this year we're going to beat Asia or Europe, or even last year when Japan beat us? I need exposure to those markets. And just, every investor has their own tolerance for that kind of exposure. In my case, the formula is very simple. It's 50% of the equity is in OUSA, which is domestic, and that's the lion's share. But 25% is in Asia, and 25% 25% is in Europe, but not just unhedged. When we built these products, and Connor can speak to the actual way we did it, which I think is very creative, we created a hedged and unhedged version. So I can buy 12.5% hedged in Europe, 12.5% unhedged. And so far, the hedged version has way outperformed the unhedged because of what's happened in currencies. And that's the great unknown for an investor like me who has to think about decades ahead. I want to be half hedged all the time. So I'm 12.5% hedged in Europe, 12.5% hedged unhedged in Europe, and then 12.5% hedged in Asia, 12.5% unhedged. So I'm using 5 tools to populate 100% of my equity positions. That's the strategy. And so I get exposure, and now I'm comfortable saying, I don't know if Asia's going to beat us. I don't know if Europe's going to beat us, but if they do, I've got exposure. And I don't have to worry about the currency changes because I've actually taken out 50% of the risk on currency with this hedge-unhedged strategy.
So Kevin has currency diversification by doing that, and that's, I think, long-term proven for many investors to be a very useful added diversification tool. The structure, Kevin just suggested I mentioned, that I think is very efficient for investors and efficient overall. Our Europe fund, OEUR, owns a portfolio of just over 140 stocks. Same rules as for the U.S. fund, OUSA. There are stocks that are in companies that are based in Switzerland, UK, and all a number of developed Europe markets. So in those currencies of the euro, the pound, the Swiss franc. The hedged version, OEUH, H for hedged, owns OEUR plus the currency hedge to have everything stabilized in U.S. dollars, and then in all cases, the dividends are paid monthly in U.S. dollars. So we did the same thing in Asia Pacific, and look at all of the major developed countries in Asia Pacific. So that'll include Japan, Australia, Hong Kong. So Hong Kong listed mega cap stocks. And again, OASI, so OAsia, is in local currency, and then OAPH, so for Asia Pacific hedged, owns OASI plus the currency hedge to keep everything stabilized in USD, and again, dividends paid monthly in US dollars.
Yeah, I noticed that your OEUR fund has a lot of exposure to British assets. Actually, a plurality of the assets are in British stocks, so there's some pound exposure there. Are you guys concerned at all about the impact of Brexit here? And is this an area where a hedged approach might make a little more sense?
You're exactly right. The hedged actually is probably the way to go for someone who's thinking of the next 6, 12, 24 months. If someone's thinking of the next 5, 10 years, that's different. But the 6 or 12 or 24 months, take away the uncertainty of which direction the pound is going to go. Is it going to keep going lower? And get the benefit that gives to all these UK-based companies. Their cost structure gets better and better as the pound gets a little bit cheaper. They're going to sell into the U.S. and other currencies and bring it back in pounds at a much higher profit margin. And so that's why owning those stocks and eliminating the currency exposure is potentially very, very interesting for the period of time when the pound is weak.
Yeah.
That would be good. You look at the U.S. U.S. had a fantastic 5-year run driven by the Fed when the dollar got weaker and weaker. Well, Europe is essentially replaying the Fed's strategy, just doing a bit of a 5-year lag. And the UK is going after that strategy relatively aggressively, driven by a bit of Brexit and a bit of current Bank of England chairman.
Yeah, and maybe we could look ahead real quick and talk about what's next for OShares. You have 5 funds right now, and I recently noticed a big filing for possible new products. 17 in total, if I'm not mistaken. And I noticed a lot of fixed income products in this group. Why the focus on bonds? Maybe you could talk a little bit about why you're looking at bonds these days.
Think about the problem for me. I've got 50% of my trust is in fixed income in perpetuity. I would love to have some of the same methodology used in picking stocks applied to picking bonds. For example, I've always, held all kinds of asset classes in fixed income. I would love to see a high yield fund that really looks at the balance sheets of the issuers in the same way that OUSA was designed to really focus on the quality of the balance sheet. I would love to see that applied on the fixed income side. I would definitely be a buyer of that, and that's one of the designs Connor's put together. Plus, there must be some mid-cap companies in the United States, Europe, and Asia that also are showing really good metrics and starting to provide returns of capital to investors with a little bit more growth to them. I would like to own some of those too. And those are the kind of thinking, given the success of what's happened to those shares, why can't we start to focus on some of these other mandates using the same philosophy?
So, Eric, you're right. We filed a prospectus a few weeks ago in which we have a set of 10 new equity funds and 7 fixed income funds. We're basically addressing asset categories for which the quality characteristics we believe will enable us to deliver to investors something that's going to be an interesting investment alternative. And we'll be bringing those out gradually. I think if you look at the prospectus, you'll see the names there. This is an international, there's an emerging market, there's a mid-cap, there's a small cap, there's a small mid-cap. On the fixed income side, investment-grade corporates, high-yield corporates, a couple of others. During this period of time, we, of course, have to say very little about the details, but the names of these funds, in every case, has the word quality in, and that reflects the zip code of OShares ETFs. We really are a provider of quality ETFs for long-term wealth management. The kind of wealth management that Kevin has for his family trust. Lower risk, long-term thinking.
Okay, well, we're running out of time, but I can't let an interview with Kevin OLeary go by without asking some more general business questions, too. First up, I've got, what do you look for in entrepreneurs? What's the number one trait that you look to find?
You know, what I found after having done this for years and years and years, so I have the history of my returns, I found that entrepreneurs that are able to articulate, this is rather interesting, the opportunity to investors and customers and employees in 90 seconds or less have done better than the ones that can't seem to explain what their business model is after listening to them for minutes. That's number one. It sounds very simple, but it's true. It's part of what leadership is, and I've got so many entrepreneurs working for me now. And the other remarkable attribute after 8 years of Shark Tank and all of these companies we funded is not some of my returns. 100% of them have come from companies either owned or run by women. And so I'm starting to look at what they do that's different, that gives them the ability to return capital so quickly and de-risk their models. And I'm starting to apply that to all of our portfolio companies. This year, the hallmark of Shark Tank, which is in the middle of production, when people start to see it in September, is just the sheer size of the deals. There are deals now coming in at $5 and $7 and $10 million. And we've never funded companies that large. So there's all kinds of new structures, convertible debentures, preference shares, venture debt deals, all kinds of different things that, you know, it's just the maturity of Shark Tank, the size of the deals, the platform it's become, have made it a remarkable springboard for not just startups, but companies that are already in the market. If you can get on Shark Tank, your sales go up thousands of % because you're getting 10 million customers seeing your product for free. It's the most powerful venture capital platform on earth. I'm convinced of that now. And it's just a fantastic show to be involved in. And I'll end with this. Just a few weeks ago, I was in San Francisco, and an 11-year-old girl came up to me and said, "Are you Mr. Wonderful on Shark Tank?" And I said, "Yeah, you should have done a convertible debenture up 20% yesterday." And I thought, how is it possible that an 11-year-old girl would even understand that structure? And her mother came running up to me and said, "Oh, she's a math whiz," but she had no idea what a convertible debenture was until she saw it on last night's show on Friday. And she just went online and learned about it. And I went, that is incredible. We're so proud of that we can be supporting entrepreneurship at an age like that. I hope to fund her one day.
Wow, yeah, that is interesting. And just the last question for you. What's the best advice you have for someone coming on to Shark Tank?
Well, you better know your numbers, or I personally will eviscerate you and you'll live in hell in perpetuity. I can't stand it when someone gets in there and doesn't know their numbers. Why are they wasting my time?
Okay, well, that is definitely something to keep in mind. Is there anything else you want to add?
Well, we think this asset class, and we're part of it, the innovation occurring in the ETF market is geometric in growth. I mean, remember, this whole market started with market cap-weighted indices, and look at where it's going. The fastest-growing asset class in the market today is smart beta. I call it rule-based, whatever you want to call it. But these remarkable strategies not only are innovation, but look at the performance. Look at the remarkable performance of what they're doing. Look at what OUSA has done versus the market. that is evidence that this kind of innovation is here to stay.
And we really believe in the structure as being more efficient for our investors, more tax effective, cost effective, totally transparent. We are believers that ETFs will gradually grow the share of investors' assets that are actually in that vehicle, as opposed to other fund structures, whether mutual funds or individual portfolios. It's a fantastic way for investors to put money to work.
Definitely. Well, thanks, Connor O'Brien and Kevin O'Leary, for joining me. I really appreciate it.
Thank you.
Yeah, thanks.
All right, once again, that was Connor O'Brien, the CEO and president of OShares, along with Kevin O'Leary, the chairman of OShares. Great having them on, and hopefully you enjoyed this podcast. And if you did, make sure to go to Zacks.com, check out the many other podcasts we have. Also, check us out on YouTube. We have some over there as well. Once again, for Zacks.com, I am Eric Dutram. Thanks for joining us.